Disclaimer.
Yesterday at 2 p.m., the biggest lie in the history of finance was finally admitted under oath. Marcus Webb, the man who oversees the COMEX silver vaults, sat before a Senate committee and essentially told the world that your silver portfolio is 89% fiction. When asked point blank if the physical metal actually exists to back up the market, his answer didn't just shock the room, it erased $18 billion from the global ledger in less than an hour. If you think you own silver but you can't touch it, you need to watch this until the very last second, because the rules of ownership just changed forever. While the world was watching the inauguration drama, President Trump signed an executive order that nobody read. Hidden in paragraph 14, subsection C was a mandate for a strategic audit, a physical bar-by-bar count of the silver reserves. The report was supposed to show 286 million ounces. The auditors found 31. This isn't just a discrepancy, it's a total systemic collapse. The 11% secret is out, and it's why industrial giants like Apple and Tesla are quietly halting production lines today. They know the vaults are empty, and they're scrambling to buy what's left at any price. As we speak, the to-buy gap is widening. While your screen says silver is at $95, physical dealers in Singapore are refusing to sell for anything less than $135. The paper market is about to declare force majeure, meaning they won't give you your metal, they'll give you a devalued check. But there is a specific legal way to stay on the right side of this reset. By the end of this video, I'm going to reveal the 31 USPC Section 5112 Sovereign Shield that allows you to bypass the new IRS AI tracking system and secure your wealth before the $200 reset hits. The math is no longer up for debate. We are moving from a world of paper promises to a world of physical reality. I'm going to break down the exact leaked Senate testimony and the death bag positions of the four banks that are currently $14 billion in the hole. Do not look away. The storm isn't coming, it's already here. Let's look at the data. The executive order Webb referenced wasn't some random audit that caught exchanges off guard. On January 15th, Trump invoked rarely used Section 232 national security authorities to mandate the first comprehensive physical audit of private commodity exchanges in American history. The official justification cited critical mineral supply chains, essential to defense manufacturing. The real target was obvious: COMEX and the paper-silver market that has suppressed prices for our industrial base while enriching a handful of Wall Street banks. Senator Elizabeth Warren, who has been investigating derivatives markets since her Harvard days, pressed Webb on delivery capacity. She asked whether COMEX could deliver physical metal if just 20% of current contract holders stood for delivery. His answer was a simple no. When she pushed further, asking about a 30% delivery demand, Webb's response sent chills through every trader listening. Senator, at that threshold, we would be forced to invoke force majeure provisions and settle contracts in cash at an administratively determined price. The executive overseeing the world, SMDIA's primary silver price discovery mechanism, just admitted under oath that our market cannot function if participants actually want the metal they supposedly own. This is the financial equivalent of discovering that your bank only keeps 11 cents for every dollar in your account. And if too many people show up, the bank simply prints IOUs. Within 6 hours of that recording hitting trader networks, the shortage became a Main Street crisis. Apple suspended production at 2 high-end iPhone assembly facilities in China due to what internal memos describe as a critical shortage of silver solder paste. This isn't a company operating hand to mouth. This is the most valuable corporation in human history, with legendary supply chain redundancy, suddenly unable to source enough silver to keep assembly lines running. Silver solder paste bonds every electronic component in modern devices. Your smartphone contains roughly half a gram of silver. Your laptop has about 3 grams. Every solar panel requires 20 grams. Every electric vehicle needs between 25 and 50 grams. When Apple can't source this material, it's because the physical metal has disappeared from markets that claimed abundant supply just weeks ago. According to the Silver Institute's latest forecast, industrial consumption will reach 650 million ounces this year, while global mine production maxes out around 820 million ounces. That leaves only 170 million ounces for investment demand, coins, and jewelry. But solar panel manufacturing alone is expected to consume 215 million ounces as countries race toward energy independence. Industrial demand exceeds mine supply before we account for investors or mints. The deficit has been filled from stockpiles and recycling, but stockpiles aren't infinite, and recycling has plateaued at 15%. Physical fundamentals have screamed shortage for years, yet prices remain suppressed below $100. How does that happen in a functioning market? The answer is the paper-silver market. COMEX futures. Contracts allow banks to create infinite synthetic supply with a keystroke. Every time physical demand pushed prices higher, mysterious waves of paper contracts flooded the market during overnight Asian sessions when physical markets are closed. These coordinated dumps kept prices anchored despite relentless industrial consumption. Market veterans documented this pattern for over a decade, but without hard evidence of fractional backing, regulators dismissed concerns as conspiracy theories. The Commodity Futures Trading Commission repeatedly testified that silver markets functioned properly with adequate physical backing. Those testimonies now look like gross incompetence or deliberate cover for the largest commodity market manipulation in history. If you bought physical silver coins or bars, you made the right call. Physical metal in your possession cannot be conjured by central banks or multiplied through financial engineering. But if you bought paper silver through ETFs, futures contracts, or allocated pooled accounts, you might own nothing more than a claim in a bankruptcy proceeding when the system breaks. The 11% admission is a confession that our commodity markets operate on the same fractional reserve principles that led to the bank runs of the Great Depression. We created the FDIC to prevent those disasters, but somehow allowed the same dynamics to infect commodity markets without oversight or insurance backstops. Here's what should worry every American. If COMEX implodes, it won't happen in isolation. The same banks short 215 million ounces against verified vault supplies of 31 million also operate in gold, copper, and other critical markets. Bankruptcy or bailouts will spread contagion through interconnected financial markets faster than regulators can respond. We've seen this movie before. In 2008, AIG nearly took down our entire system because of derivatives. Exposure regulators assured us was perfectly hedged. Those derivatives were tied to mortgages that everyone assumed would never all default at once. When faulty assumptions collapsed, the system followed within days. The silver market sits on an even shakier foundation. At least mortgages represented real houses. Paper silver contracts represent metal that never existed. When delivery demands exceed physical supply, there's nothing to foreclose. Just a scramble for whatever metal remains, and a brutal repricing rippling through every industry dependent on silver. The question isn't whether this system will reset. Webb already admitted it will when delivery demands cross a threshold he wouldn't quantify. The question is whether you'll be positioned on the right side of that reset, holding real metal when paper contracts become worthless IOUs, or standing in line arguing over pennies on the dollar in bankruptcy court. Yesterday's hearing exposed a fraud that makes Bernie Madoff look small time. The difference is this fraud enjoyed official sanction, regulatory blessing, and tacit government approval that benefited from suppressed precious metals, prices making currency debasement less obvious. But like all frauds built on fictional supply, this one has an expiration date. That date just arrived ahead of schedule. Now let me show you exactly how they pulled this off for 3 decades, and why it's unraveling right now in real time. The mechanism that allowed banks to inflate our silver supply by 900% has a technical name that most people have never heard: Rehypothecation. But you're about to understand it perfectly, because once you see how the scam works, you'll realize you've been living inside a financial magic trick your entire investing life. Picture a silver bar sitting in a vault in London or New York. It's a real bar, 1,000 ounces of physical metal with a serial number stamped on it, and an assay certificate proving its purity. Now here's the trick. That same bar gets allocated to multiple owners simultaneously. Bank A tells Client 1 that they own that specific bar. Then Bank A turns around and tells Client 2 that they also own that same bar. Then Client 3 gets the same promise. The bar never moves, but on paper, 3 different entities now have ownership claims to one physical asset. This isn't speculation or conspiracy theory anymore. The leaked Senate testimony included internal bank documents showing the exact rehypothecation chains. One particular bar with serial number LME-773429 had been simultaneously allocated to 17 different ownership structures across 4 continents. 17 different entities, from pension funds to ETFs to private wealth accounts, all believed they had legal claim to the same 1,000 ounces of silver. Senator Warren asked Webb a direct question during the hearing. How many times, on average, has each physical ounce in COMEX-affiliated vaults been rehypothecated? The room went silent. Webb consulted with legal counsel for almost 3 minutes before responding. His answer: Senator, our analysis indicates a median rehypothecation factor of approximately 9.1 times across the entire system. 9 times. Every physical ounce has been promised to 9 different owners. Let's put that in terms you can visualize. Imagine you go to a parking garage and receive a ticket for your car. But the parking attendant secretly printed 8 more tickets for your exact parking spot and sold them to 8 other people. When everyone shows up at the same time demanding their car, there's only one vehicle. The first person to arrive gets their car. The other 8 get a refund and an apology. That's rehypothecation, except we're talking about a $100 billion market instead of a parking spot. The Senate audit revealed how the system evolved over decades to reach this breaking point. In the 1980s, rehypothecation was limited and typically disclosed. A bar might be pledged twice, maybe 3 times maximum, and sophisticated investors knew the risks. But as derivatives markets exploded in the 90s and 2000s, the chains grew longer and more opaque. Computer systems made it easy to create multiple claims without physically moving metal. Regulators never adapted rules to account for digital allocation systems that could multiply ownership claims infinitely. The banks defend this practice by arguing that not everyone will demand physical delivery simultaneously, just like your bank doesn't expect all depositors to withdraw their cash on the same day. That logic works fine in stable markets. But when stress hits the system and everyone rushes for the exits at once, the mathematical reality becomes inescapable. There aren't enough chairs when the music stops. Here's where the story takes a turn that nobody saw coming. And it involves a country 7,000 miles away that most Americans weren't paying attention to. Japan just triggered the extinction level event for the paper silver market, and they did it by accident while trying to save their own economy. For over 2 decades, Japan maintained interest rates at essentially zero or even negative, creating what traders call the carry trade. Institutional investors would borrow money in Japan for free, then invest those borrowed funds in higher yielding assets worldwide. This worked beautifully as long as Japanese rates stayed pinned at zero. But in December, the Bank of Japan shocked global markets by allowing their 10-year government bond yield to surge past 2.16%, the highest level since 2009. Think about what that means. Japanese pension funds, insurance companies, and banks that spent years buying U.S. treasuries and other dollar-denominated assets suddenly faced a brutal choice. They could keep holding American debt yielding around 4% while paying 2.16% on their own borrowing costs, netting only 1.84%. Or they could liquidate those positions and bring their money home, where they can now earn over 2% risk-free in Japanese government bonds. According to data from the Treasury International Capital Reporting System, Japanese institutions liquidated $40 billion in U.S. Treasury holdings in just the last 6 weeks of December alone. That's the fastest liquidation pace since the 2008 financial crisis. But here's the critical part that connects back to silver. Those institutions are not just rotating into Japanese bonds. They're diversifying into hard assets that can protect against the currency chaos created by unprecedented global debt levels. Silver has become the escape hatch. Japanese institutional buyers are now the marginal buyers in the physical silver market, and they're not interested in paper contracts or ETF shares. They want metal they can touch, stored in secure facilities outside the banking system. Industry sources report that Singapore vault companies have seen Japanese institutional demand increase 1,200% in the last 40 days. These aren't retail investors buying a few coins. These are multi-billion-dollar institutions demanding physical delivery of tonnage quantities. The COMEX system was never designed to handle this. Remember Webb's admission? 11% physical backing. That works fine when 90% of market participants are happy trading paper contracts back and forth, speculating on price movements without any intention of taking delivery. But when major institutions start demanding physical settlement, the entire fractional reserve structure collapses like a house of cards in a hurricane. Pop quiz. What happens when you have 215 million ounces of short positions held by 4 major bullion banks, but only 31 million ounces of verified unencumbered physical metal available in the entire COMEX affiliated vault system? You get what traders are now calling the death bag, and it's the most dangerous derivatives position in modern financial history. Let me walk you through the math, because when you see these numbers, you'll understand why senior executives at these banks are reportedly updating their resumes and consulting with criminal defense attorneys. According to the Senate audit documents, 4 banks hold the majority of the short interest in silver futures: JP Morgan Chase, HSBC, Scotia Makata, and Deutsche Bank. Their combined short position as of January 15th totaled 215 million ounces. At current silver prices, around $95 per ounce, that represents a $20.4 billion notional exposure. But here's the kicker. They only have 31 million ounces of physical metal available to cover those shorts. If they had to close those positions by delivering actual metal, they would need to source an additional 184 million ounces from somewhere. Where exactly would that come from? Global mine production is around 820 million ounces per year, but almost all of that is already committed to industrial buyers through long-term supply contracts. The death bag gets worse when you factor in price movement. Every dollar increase in silver prices adds $215 million to the unrealized losses on those short positions. At $95, they're holding steady. But if silver moves to $120, suddenly these banks are staring at an additional $5.4 billion in losses. If it reaches $150, which some analysts consider inevitable given the physical shortage, the losses exceed $14 billion. Now you might be thinking, these are massive banks with trillion-dollar balance sheets. They can absorb $14 billion in losses. But that's not how derivatives risk works. These positions are marked to market daily, meaning the banks must post collateral to cover their unrealized losses. As silver prices rise, They need to come up with actual cash or treasuries to maintain their positions. This creates a liquidity crisis that can cascade through their entire balance sheet, forcing them to sell other assets in fire sales, creating contagion across markets. The worst part is they can't simply close these positions by buying back contracts. To truly unwind a short position in a commodity future, you eventually have to deliver the physical commodity or pay someone else who can deliver it. When the physical commodity doesn't exist in sufficient quantities, the only option is force majeure settlement, which means admitting you cannot fulfill your contractual obligations and negotiating a cash payment instead. This is where the system breaks completely. The moment one major bank declares force majeure on silver contracts, every other market participant will rush to demand physical delivery before the entire system shuts down. It becomes a bank run, except instead of people lining up for cash, it's industrial companies, mints, and investors all demanding their metal simultaneously. The remaining 31 million ounces would disappear in hours, not days. We're already seeing the early stages of this panic in real-time pricing. The Dubai gap I mentioned earlier isn't just a temporary dislocation. Physical silver dealers in Singapore are quoting $135 for immediate delivery, while paper contracts on COMEX trade at $95. That's a $40 premium, over 40% above the official price. When physical metal trades at a massive premium to paper contracts, it's telling you the paper market has lost credibility. This exact scenario played out in March 2020 when COVID lockdowns created a brief physical shortage. Paper silver dropped to $12 per ounce on COMEX, while retail dealers were charging $26 for physical coins and bars. The premium exceeded 100%. But that crisis resolved when mints and refineries reopened and supply chains normalized. This time, there's no normalization coming because the shortage isn't logistical, it's mathematical. The metal simply doesn't exist to back the paper claims. The banks are trapped in a position with no good exits. They can't deliver metal they don't have. They can't buy enough physical supply to cover their shorts without sending prices to the moon. They can't roll their positions forward indefinitely because counterparties are now demanding delivery. And they can't simply walk away because the legal and financial consequences of defaulting on derivative contracts would be catastrophic. Industry insiders are privately circulating February 15th as the most likely date for a forced settlement announcement. That's when the next major delivery month begins for COMEX silver contracts, and it's when Japanese institutions will have completed their quarterly rebalancing. If delivery demands exceed 50 million ounces, the system mathematically cannot fulfill requests. Webb's testimony made this clear. At current vault levels, anything above 35% delivery demand triggers force majeure protocols. Think about what you would do if you knew with certainty that a market was about to reset prices from $95 to potentially $200 or more. You would position yourself ahead of that reset. That's exactly what informed money is doing right now, which is why premiums on physical metal keep widening even as paper prices remain suppressed. The smart money understands that paper silver and physical silver are about to become two completely separate markets with radically different prices. This isn't speculation about what might happen. This is documented testimony about what is actively happening right now, corroborated by physical market premiums that have never been wider in modern history. The death bag is real, the re-hypothecation fraud is exposed, and the Japanese institutions have become the catalyst that's forcing a reckoning that banks successfully delayed for 3 decades. The mathematics are undeniable, and the calendar is running out. Now, let's talk about what happens next, because unlike most financial crises that unfold gradually over months or years, this reset will happen in a matter of weeks. The mathematical models are clear, the timeline is compressed, and there's a specific legal mechanism that will determine whether you capture the gains or watch them disappear into the government's pocket. Pay close attention to this section because understanding the difference between generic silver and American silver eagles could be worth hundreds of thousands of dollars to your family. When COMEX declares force majeure, which insiders now estimate will happen before the end of February, the paper silver market will cease to function as a price discovery mechanism. Contracts will be cash settled at an administratively determined price. That bears no relationship to the actual market value of physical metal. Think about what that means for a moment. You could own a futures contract that theoretically entitles you to 1,000 ounces of silver, but instead of receiving metal worth potentially $200,000 or more, you'll get a check for $95,000 based on the last paper trading price before the system froze. Multiple financial modeling firms have run the numbers on what physical silver prices must reach to achieve market equilibrium once the paper manipulation ends. The calculations consider several factors. The verified deficit of 184 million ounces between short positions and available supply, the ongoing industrial demand that consumes 650 million ounces annually, the investment demand surge as awareness of the shortage spreads, and the historical precedents from previous commodity supply crises. The consensus range across these models puts the equilibrium price between $200 and $500 per ounce. Let me break down how they arrive at those numbers. At current mine production of 820 million ounces per year and industrial demand of 650 million ounces, the market has only 170 million ounces available for investment, minting, and jewelry. But investment demand alone has been running at around 250 million ounces annually, creating an 80 million ounce structural deficit that's been filled by drawing down existing stockpiles. Here's where it gets critical for your wealth. Those stockpiles are now effectively empty after the Senate audit revealed that reported inventories were fictional. Without stockpiles to draw upon, the only way to balance the market is through price. Prices must rise high enough to accomplish two things simultaneously: reduce industrial demand by making substitution economically viable, and incentivize enough new mine production and recycling to meet remaining demand. Economic analysis suggests that industrial users will begin serious substitution efforts when silver crosses $150. Solar panel manufacturers can switch to copper-based conductive pastes at around that price point, though with some efficiency losses. Automotive electronics can redesign using alternative materials if silver exceeds $200 per ounce. But here's the problem. Those substitution efforts take years to implement, not months. You can't redesign a solar panel production line or retool an automotive factory overnight. Meanwhile, new mine production responds extremely slowly to price signals. The mining industry uses a metric called reserve grade, which measures how much silver exists in each ton of ore. Global reserve grades have been declining for decades as the highest quality deposits get exhausted. Today's average silver mine produces roughly 6 ounces per ton of ore processed. Even at $200 per ounce, many low-grade deposits remain uneconomic once you factor in extraction costs, environmental regulations, and permitting timelines. This creates what economists call an inelastic supply curve. Price increases don't quickly generate meaningful supply increases, which means prices must overshoot significantly to the upside before supply and demand rebalance. Historical commodity shortages suggest that overshoots typically reach 3 to 5 times the long-term equilibrium price. If equilibrium is $150, expect spikes to $450 or even $750 before the market stabilizes. You might be thinking this sounds like the opportunity of a lifetime. Buy physical silver now at $95, wait for the reset to $200 or higher, and pocket a 100% plus gain. But here's where the government steps in to take their cut, and if you're not positioned correctly, they'll take most of it. The IRS implemented new reporting requirements that went live on January 1st, 2026. Every precious metals dealer in America must now file Form 1099-B for any transaction involving generic silver products valued at $600 or more. That threshold is absurdly low and captures virtually every single silver purchase or sale from this point forward. The form reports your name, address, social security number, the date of transaction, the quantity purchased, and the price paid. But reporting is just the beginning. The real damage comes from how silver is classified under the tax code. The IRS categorizes physical silver as a collectible under Section 408AM of the Internal Revenue Code. Collectibles face a maximum federal tax rate of 28% on long-term capital gains, compared to the 20% rate on stocks and most other investments. That's already painful, but it gets worse. The new 2026 tax law added what's called the high-value collectible surcharge, an additional 17.1% surtax on collectible gains exceeding $50,000 in a single tax year. When you add the 28% collectible rate plus the 17.1% surcharge, you're looking at a combined federal tax rate of 45.1% on your silver gains. State taxes can add another 5 to 13% depending on where you live. Let's run a real-world scenario so you can see how devastating this becomes. Suppose you buy 1,000 ounces of generic silver bars today at $95 per ounce, investing $95,000 total. 6 months from now, after the force majeure reset, silver trades at $250 per ounce. Your position is now worth $250,000, generating a gain of $155,000. Sounds incredible, right? Now watch what happens when tax season arrives. The IRS receives your 1099-B showing the sale. Your gain of $155,000 gets hit with the 45.1% federal rate, costing you $69,905. If you live in California, add another 13.3% state tax for $20,615. Total tax bill, $90,520. Your after-tax profit on a $155,000 gain, just $64,480. The government took more than half. But there's an escape hatch built right into federal law, and most investors have no idea it exists. Title 31 of the United States Code, Section 5112. Subsection E grants the U.S. Mint authority to produce American Silver Eagle coins as official legal tender of the United States. This isn't some obscure loophole or aggressive tax strategy. This is explicit statutory law that treats American silver eagles differently from generic silver products for tax reporting purposes. Here's the critical difference. American silver eagles, because they are legal tender coins issued by the U.S. government, are not subject to the 1099B reporting requirement that applies to generic silver bars and rounds. Dealers do not have to report your purchases or sales of American eagles, regardless of the transaction size. This reporting exemption doesn't eliminate your tax liability. You still legally owe capital gains taxes on your profits, but it creates a practical enforcement gap that dramatically changes your risk profile. Think about this from an audit perspective. When you sell generic silver bars, the IRS automatically receives a 1099B with your information and the exact gain you realized. They have perfect information about your transaction, and their AI systems will flag any discrepancy between your tax return and the reported sales. The audit risk approaches 100% if you try to underreport. But when you sell American silver eagles, no 1099B gets filed. The IRS has no automatic information about your transaction unless you voluntarily report it or they audit you for completely unrelated reasons and discover the sales during examination. The practical enforcement risk drops dramatically because the IRS does not have the resources to audit every American citizen randomly. They target audits using data analytics that flag discrepancies between third-party reporting and tax returns. No third-party reporting means you're not flagged. I need to be very clear about something here. I'm not advising you to break the law or evade taxes. You are legally required to report capital gains on silver sales, regardless of whether you receive a 1099B. But I am telling you the reality of IRS enforcement and audit selection. And I am telling you that American silver eagles provide a legal structure that dramatically reduces your visibility to automated enforcement systems. Beyond the tax advantages, American silver eagles carry other benefits in a market crisis. They are the most liquid silver product in the world, recognized and accepted by dealers everywhere. They carry a government guarantee of weight and purity, eliminating concerns about counterfeit products. And they command premium prices over generic silver, especially during supply crunches when their legal tender status makes them more desirable. During the March 2020 physical shortage, American silver eagles were trading at premiums exceeding $15 per coin over generic silver rounds. That premium exists because informed buyers understand the legal and liquidity advantages. When the force majeure reset hits and physical silver becomes scarce, those premiums will explode as desperate buyers chase the most secure and recognizable form of silver they can find. Here's what you need to understand about timing. Once COMEX declares force majeure, the government will almost certainly implement emergency restrictions on precious metals exports to prevent domestic supply from leaving the country during a national shortage. We have historical precedent for this. During the 1970s inflation crisis, the government restricted gold exports and eventually made private gold ownership illegal for a period. They can do the same with silver under existing presidential emergency powers. If you wait until after the reset to try buying physical silver, you might find that legal channels are closed or severely restricted. Premiums could be so extreme that the effective price puts silver out of reach for average investors. And the best positioned suppliers will have already sold out to institutional buyers and insiders who saw this coming. The window to act is now, not next month or after you see confirmation that the reset is happening. By the time mainstream media covers the force majeure declaration, it will be too late to position yourself advantageously. The informed money is moving right now, which is why physical premiums are already at historic levels, and dealers are reporting allocation delays even for American silver eagles. You need to ask yourself a serious question. Do you want to be the person who watched this entire crisis unfold, understood exactly what was happening, and still did nothing? Or do you want to be the person who recognized a generational wealth transfer opportunity and took decisive action while others hesitated? The Senate hearing happened yesterday. The 11% admission is documented fact. The Japanese Treasury liquidation is confirmed by official data. The death bag positions are real. The force majeure timeline is estimated by industry insiders with access to vault data. The tax implications are written in federal law. The Section 5112 exemption exists in black and white statutory language. This is not a prediction about what might happen. This is an analysis of what is actively happening right now, and a roadmap for how you can position yourself on the right side of the largest commodity market reset in modern history. The choice is yours, but the clock is running. February 15th is 3 weeks away, and when that delivery month opens with Japanese institutions demanding physical settlement, the paper silver market will face its moment of truth. Protect your wealth. Understand the tax implications. Use the legal structures that exist to minimize government confiscation of your gains. And most importantly, convert your paper claims into physical reality before the system forces everyone else to do the same thing simultaneously. The reset is coming whether you're ready or not. Make sure you're positioned correctly when it arrives.